Hey, good afternoon. Corey Schrader, Black Creek Wealth Management. Hope you all are doing well. Wanted to get in front of you and just give you a couple of some trades and things that I'm looking at this week. I'm going to stick primarily with mostly technology as well as the S&P and triple Q indexes this week. And what we're going to be looking at, if you follow my other recording here, is it's going to be a bouncy week. And with a bouncy week comes good opportunities. Now, way I'll be looking at it is on the indexes, I'm looking at it from a range trading perspective, meaning that there's a range of prices that things are going to be moving at. Versus when I look at the high PE stocks or the technology stocks, what I'm looking at is what is the floor that I should be looking at when it comes to price movement on some of the trades that I make. And it's primarily because I do spreads and I want to make sure the prices really don't get anywhere near where I'm going to be. And if I do that, we're going to have a pretty good week. So let me just go ahead and show you a couple of trades. I'll show you two in particular that I've actually go ahead and put on here today. So let's take a look. All righty. So if we look at the S&P 500, again, indexes, what I like about them the most is they provide an inherent risk management type of scenario because there's 500 stocks. If one of them takes a hit, you're not feeling 100% of that brunt because, of course, you have 499 other stocks. So it's kind of nice. And it's also a reason why a lot of people, when you're just starting to invest, if this is you, and you just want to start putting money aside, you can look to the S&P 500 as just a starting point. When you start really digging into more of where to invest and all that, it's really going to depend on what you're actually trying to invest in. But if you don't have a short time horizon, like a year or even 5 years, then yeah, just start feeding the beast, start feeding the old SPY, VOO, if you like Vanguard, and just get into the actual overall market. It's diversified in and of itself. But again, it is for growth money. And since I'm a growth investment manager, that is what I would tell you. So again, everyone's situation dictates. If you have questions, give me a holler. So here's what I'm looking at this week. Is this concept of what's called spread trading. And all that means is I am buying and selling the same type of options contracts, whether they're calls or puts, and attempting to figure out where's the right price movement for the week. And what I do is I look at it from a very bullish perspective. And what that means is I believe that the market's going to go up. Well, it's great when the market goes up, but it's challenging when the market goes sideways. So for instance, like what's going on right now with the S&P 500 is let's say I was, trading a couple weeks ago, and I'll switch this to the weeklies. I was trading a couple weeks ago, and you have a huge decline like this. Look at this: 1, 2, 3, 4, 5, 6, 7. Strategy I do is a bullish strategy, but I've had 7 weeks of declines. Well, again, you are attempting through this, what is called a bull put or bull call spreads, is an attempt to figure out where's the market going from here. And because it's bullish, it expects the market to go up. So in weeks like this, we're making money. There's nothing to really control from a risk management perspective. But when the market drops, you have to be paying attention. So for the last 6 months, I've been basically glued to my computer on a short-term basis. And again, this is not long-term investing. This is short-term, taking advantage of this and making money while the markets are gyrating. Okay. So when I looked at what's going on this week, you can clearly see huge declines. You see volume starting to come down, which is a positive sign, because if you have all the selling, usually you don't want to see an increased volume, because that means you have what's called strong supply, and that just pushes prices lower. So what we're actually going through is a period of weak supply where you have prices declining and you have volume that is, you have supply that's declining, but it's increasing its push downward because you have so much supply. So people are just, hey, sell. And then you have what's called weak supply right now, where now prices are starting to somewhat gyrate, but volume has really just dropped off. So there's not been a huge amount of demand back out there. So what it's telling me is the market is starting to lose its level of certainty as far as where does it want to go from here. So I'm looking at the level saying, okay, I know over the last 7-8 weeks, prices have basically been floating somewhere around here. right around that 430 mark. Excuse me. And then I look at it from the lens of what is the possibility or probability. It's definitely possible that it could get up to 430, but what's the probability? Well, let's take a look at it. So if we look at the actual probability of it hitting 430 over the next. All right, sorry about that. I had to move. It's currently pouring out now. So, all right. So if we look at where I left off, so you can tell a little bit here that there's a little bit of some range going on. And as of right now, what I would tell you is that 425 in the S&P 500, which is a pretty good move. I believe that's about 4.5. Yeah, it's about 3.5 to 4%. So when you look at what's going on a weekly basis, and I've run all kinds of analysis on this, just in general here recently, the market has found a way to gyrate. And when I say the market, I mean S&P. The S&P is basically gyrated about 3.5 to 4.25, with some outliers like at 6%, 7%. So there's definitely, of course, these huge spikes that you got to watch out for. So what I'm getting at here is by using the tools and looking at simple moving averages, which is what we have here. So this is the 200-day moving average. This is my 50-day exponential moving average. And you can clearly see we're still in a downtrend, although we're still in a long-term uptrend. So I know that there's still an upward bias in the actual S&P 500, at least on a weekly perspective over the last 3 years. Now, when I look at it on a daily perspective, you can see, and again, here's the 200-day moving average. Here's the 50. So we're now in a bearish environment on the short term, but we're starting to meander a little bit higher above this 20-day moving average. So in general, there's a level of support that's going through the S&P 500. So when I look at this, I'm like, okay, I know that I can place my spread trades somewhat lower from the current price action and have some level of comfortable, cautious concern, I would say, and see that I do have plenty of room if this thing does need to drop and I need to close out the position. So what I would tell you is if you're looking at a cover call this week, or you're looking at doing spread trading, I would definitely give yourself about a 5% buffer north and south and look at what those options and those kinds of things are. And what you can look at on a weekly basis is averaging anywhere, depending on how close you want to get to price action, you want to get up here, you could have returns as high as 30%. Yeah, you around here, you probably do about a 10% weekly return. So it's just really up to your ability as far as how much risk you want to take on and how much of this swing you want to deal with. So that's what I'm looking at on the S&P 500. Now, when I go to something like, let's pull up good old Netflix. So Netflix, we want to go ahead and as just short-term traders, we want to look at long-term to short-term, okay? So let's look at this. Wow, right? Huge drop, huge drop. Now, the biggest thing to take away from with this is that the actual dynamics of the company has changed, okay? They've lost a lot of subscribers. And again, I look at it mostly from a technical perspective, but you still got to acknowledge the fact that the company itself has changed. And there's no arguments on this. I mean, you can't be in the way of this, right? So this is what is called idiosyncratic risk or single stock risk. So when I talk about being in an ETF and having it diversified, you're not dealing with this, right? That's one stock and it took a drop and now you have to deal with it. I could show you Target. Target did the exact same thing. So there it is right there. It's actually right next to each other, unfortunately. So Target, good consumer discretionary stock, right? Took a huge drop. So that's what you deal with when you deal with independent stocks. But with that, higher volatility means you can make some money. So when you look at this, again, it's a stock. It's not going to be pulled out of the index anytime soon. It has a huge backing. It has huge institutional ownership. So there is a lot of positive here. And that's why we look at these kind of trades. And it's been completely just beat up. So therefore, you have value investors that come in. But if you went and listened to my other call, there's something called a dead cat bounce. You got to watch out for it. Had a huge drop. It could just be a short-term spike and then drop off. But what I'm looking at is what would it potentially do on a weekly basis? So if you're in target, what I would tell you is it's sitting right on its 200-day moving average at about 150 and some change, right? So what I would look at with this stock is, okay, how much more wiggle room can I have? And this would probably be a really good stock for what's called a cash secured put. So you would sell a put down here, and if the price drops, well, now you own the shares at 126 versus had you bought them here and then done a covered call, right? So it just gives you an ability to say, you know what, I really like Target at 125 or 126. Let me go ahead and sell some option premium, make some money while the price maybe figures itself out. And then if it drops, now I'm getting shares at this really deep discounted price relative to where it was a couple of years ago. And again, this was COVID, right? So pre-COVID, it was at 121. Think about that for a second. So you could easily set it, because once this 200-day moving average is broke, there's going to be a definite test here. And it may happen soon, it may not. But that's something you got to watch out for this week. So those are a couple of trades I'm looking at. Again, if you have any questions or want me to elaborate on any sort of term or technical thing I talked about, let me know. But overall, appreciate you listening in. Have a blessed day, and I'll talk to you soon.